Okay, fam, we got to talk about Tesla because this is serious. With the Feds getting ready to cut interest rates today and announcing the amount they're going to cut, this is very similar to the economic conditions in 2007. Let's get going, fam. Let's dive right into Tesla and the market conditions and the rates being cut today. Economic data from 2007 and 2024 are strikingly similar with what's going on in the economy and the interest rates and trying to prevent inflation, although the speaker does not feel like we are going to have a recession like 2007. Unemployment, inflation, housing, all very similar between 2007 and 2024. In 2007, the market rallied very strong after the interest rate cut, but then fell sharply short after. The Fed's rate cut may not affect the stocks today like it did the cyclical sectors back in 2007. So there's a difference in the sectors, what's going on with big tech, AI. Things are a little bit different. They're a lot more robust if you want to know the honest truth. There is a high chance of a sell the news event similar to 2019 with the Feds cutting interest rates and the markets being at all-time highs like they are right now. The Feds have said that they're going to be cutting interest rates by 25 basis points, but there's others that are saying that it's going to be 50 basis points, even 75 basis points has been talked about. I feel like the rate cut's either going to be 25 or 50. I would be shocked if it's more. The market is going to be very volatile today, and the interest rate cut is going to be happening in a couple hours from now, or at least the announcement of the news surrounding it. So when you're watching this video, we're very close to the rate cuts, but I anticipate a 25 or a 50 basis point cut. 75 is pretty high. Before we get more into this video, I have a huge announcement. I am offering yet again, because so many students missed it, my free masterclass webinar this Monday, September 23rd, 8 p.m. Eastern time, 5 p.m. Pacific time. I've had so many people that missed the past webinars, and this is your chance to get in. I have a huge announcement during this webinar, and I'm also going to be taking your questions and answers. There's going to be a section dedicated for that. You will learn more in the hour that you spend with me on this webinar than you will anywhere else. That's what every single person that's joined these webinars has said. Every single student that's joined my Discord during the webinars or after the webinars have said the exact same thing. If you guys want to jumpstart your financial freedom, I will see you on the webinar. Spots are very limited, and once they're full, you will not be able to join. So you guys want to check out the link. It's in the information box below. So I want to put something on the screen for you guys to see. The inflation in 2006 was 3.2%. It went up to 3.8% in 2008 during the rate cuts. And right after the rate cuts, the market recovered and inflation went to negative 0.4, which is really not that good. What you really want to see is inflation to be a little bit more stable, around 2%. But lower is definitely better, but in the negatives and like falling below 1% and then jumping back up again is not really stable. But the year after that in 2010 was 1.6%. So we had a lot of stability the year after the rate cuts. During the rate cuts, there was a lot of volatility. So I expect that with a 2.5%, the Feds have learned from this, and they're going to cut sequentially in a timely fashion over a 3-month, 6-month, or 1-year period. This way to counteract that kind of sharp knife drop in inflation, which will also affect the stock market. We don't need to start cutting rates and go from 2.5 to 1.1 or 0.9, and then the stock market buys up and then it sells off and we have all this volatility. I don't think that's going to happen this time around. And I believe the Feds are going to cut 25 basis points, maybe 50. I just don't see 75 being likely, but then doing this in a consistent manner, and instead of being reactionary, it's proactive, because the rate cuts in 2007 and 2008 were kind of reactionary. Now we're proactive. The Feds have learned from their previous mistakes. So I don't feel like we're going to be facing any of these issues going forward. This is going to affect Tesla a lot more, I think, than it's going to affect NVIDIA or AMD, because NVIDIA and AMD are tech stocks, AI. You have to understand, when you're investing in Tesla, Tesla's not just automotive. They are a data acquisition hub, an automotive EV company. They are an autonomous driving and AI company, and they're in bed with NVIDIA with their Blackwell chips and a lot of their server processors and servers. So Tesla's very much so an AI, autonomous driving and data hub masquerading as a car company. I fully believe, because of all of these aspects of Tesla, they're going to be affected. And I think when the rates start getting cut and PMI data comes out in October, November, and December, and the economy starts to get stronger and it stabilizes after elections, Tesla Tesla is going to run. I think next year in 2025 and the year after in 2026, Tesla is going to go ballistic. This is really the only EV stock that's doing what it's doing right now, in America at least, for sure. Tesla is like NVIDIA. AMD's starting to step up. Intel's trying to catch up. But when you really think about it, who's competing with Tesla? Rivian, Lucid Motors? I mean, it's not a whole lot of competition between Rivian, Lucid Motors, and Tesla. The only company that's putting up any numbers against Tesla is NIO, and that's in China. That doesn't really matter over here because Tesla's outselling NIO in China. They're outselling NIO in Europe big time, and they're outselling everyone in America. Tesla has a big portion of the market share. They are the largest EV manufacturer in the world, just like NVIDIA is the largest chip manufacturer in the world. We're not really the manufacturer, but Taiwan Semiconductor makes the chips. But the actual AI chip and server company, NVIDIA, gaming, GPUs, they have the biggest market share for retail, just like Tesla has the biggest market share for automotive EV. You will see as time goes on that I'm likely to be right, that as the rates start getting cut and PMI data comes out and the stock market stabilizes and the elections come and pass and things get better going into the new year, Tesla is going to start moving, especially with robo-taxi and the autonomous driving updates to the actual software in the Teslas that are currently on the road. This is all going to be huge news for Tesla, but there is a chance that we could have a knife pullback on interest rate cuts, which is why I think the Feds are going to be cutting interest rates very consistently and slowly as to not create this knife drop. But there is a chance after the first rate cut, with the elections being here, that October, November, and part or most of December could be a little on the rough side. We could have a dip, come back up. And then after that, we stabilize, and going forward into the new year in spring, the stock market starts climbing again. So be aware of that. There are some dangers here. I don't feel the stock market's going to knife down, and I definitely don't feel like we're going to be hitting a recession. I feel like things are a lot different. When I look at the data here, I can tell you guys, I'll show it to you guys on the screen again, that in 2008, it was 3.8%. And by 2010, it was 1.6%. So it took a year or two. Rate cuts happened. It took 2 years to stabilize at 1.6, but however, it did kind of drop drastically. The Feds know this, so they're not going to do that this time. So I think it's going to be more stable. I think 6 months down the road, as we get into spring, things will be a lot better, and by summer, things will be right on track. When we look how interest rates were, they were 1.6, 3.2 in 2011. Things got a little bit bad again, but then in 12, 13 and 14, it was between 1.5 and 2.3. Very stable for those 3 years. I remember that was a very good 3 years in the economy. My business at the time was doing very well. 2015 was 0.1. My business was doing excellent. And in 2016 and 17, it was also doing well. But 17 and 18, my business wasn't doing well. And coincidentally, in 2018 and in 2017, for that matter, interest rates went to 2.1 and 2.4. From where they were in 2014, 15, and 16, which was averaging between 1 and 1.5. So it's all relative. Really, the ideal spot to be is between 1.5 and 2. Economy is very strong there. Right now, we're at 2.5. We were at 2.9, so it's getting better. And then in 2020, it was at 1.2. 2020 was actually pretty strong at the beginning of the pandemic. As the year went on, things got rough. Stock market did well in 2021, but it was at 4.7% inflation. Then we're up to 8% in 2022. Then we went down to 4.1 in 23, then 3.2 in 2024. Then we fell from 3.2 to 2.9 this year, and then down to 2.5. So in this year, in 6 months, we went from 3.2 to 2.5. So we've had a 0.7% drop, and from 2023 to 2024 in a year, which is double the amount of time, we had a 0.9 drop. So inflation has dropped over the last 3 to 4 months as much as it did in the previous 12 to 14 months. That's pretty significant. That's why Tom Lee said inflation's falling like a rock. Starting at the beginning of this year, inflation started dropping quite a bit. In this last 3 to 4 months, it's really come down compared to where it was before. If you guys are having trouble understanding CPI data, PMI data, all of this interest rate talk, federal interest rates being cut, and you're having trouble in the market making profits, I would love to help you. I offer a full training course Discord, and one-on-one coaching. You guys can sign up at any time. InvestWithCorey.com. Right there on the screen. Link is also in the information box below. Spots are very limited, and it's a very serious mentorship. So if you are committed to your financial freedom and success, I'm committed to helping you achieve those goals. You guys can sign up at any time. Most of my students in the first month are up 10 to 15%, and by the second month, they're up 30 to 40% on their portfolio. If you guys would like to achieve this kind of success, I would love to help you. Now, Tesla wasn't around back then. During the 2008 recession, they weren't listed on the stock market, so there's really no data to go off of how Tesla would react to such rate cuts or pre-type inflation situations with the economy where the feds are proactively cutting rates or reactionary cutting the rates. So it's really hard to say how Tesla would actually handle this situation or how it would react to the stock market and the rate cuts. But based off of history and the type of stock that it is and the demand for it and the fact that it's also involved with consumer spending because you have to buy the cars, there would be a pretty big move, in my opinion, as the rates get cut and the economy gets stronger. So it's in my opinion that Tesla will actually run pretty well after the economy and inflation has settled down after the elections and things get a lot better. It's highly likely Tesla will actually make a pretty big run already anyway, just because of the strides they're making in AI with NVIDIA and the autonomous driving and the robo-taxis and their own vehicles that they're enhancing and producing better vehicles over time as they evolve into a better automotive manufacturer. So with all of this being said, the PMI data is good every month going forward. The rates are getting cut and the economy is stable and there's no recession. I think the rates being cut and all of that compiled together into one is a breeding ground for an explosion on the Tesla stock. And because it's not in the tech sector directly like NVIDIA and AMD or Intel or Taiwan Semiconductor or AMAT and some of the other stocks, which is Applied Materials, by the way, I think that Tesla has a much better chance of success. We need cars, and EV is the way of the future for cars. And Tesla's the biggest EV manufacturer in the world. With all this put together, them kind of breaking ground and leading the way with EVs and autonomous driving and robo-taxis, I believe that they're going to do very well in a post-high interest rate inflation type economy. And I believe that's the best stock to buy right now, at least out of the large ones. Apple will do well, I believe, as well, and so will NVIDIA and AMD. But I feel that Tesla is the one that's going to benefit the biggest in the shortest amount of time. Now is the time to buy Tesla already. With interest rate cuts and everything else, definitely the time to buy Tesla. Ultimately, we have to see what's going on with Tesla and the market, and that's all going to be happening today. We'll see the reaction. We're going to see what goes on between now and the elections, but I would highly suggest looking at selling puts on Tesla. If you already have Tesla, stay in it, hold to your position, dollar cost average, because I believe this is going to be a great stock going forward with rate cuts, even better than it already is, because it's already a great stock. So really, the biggest takeaway from this is that when the feds are cutting rates proactively like they are now, if it's consistent and stable, like I'm sure it will be because they've learned from previous mistakes, Tesla and the stock market is going to do very well. And Tesla specifically, in my opinion, is going to run pretty strong. And it's going to be a situation where you're going to wish you hadn't. Free masterclass webinar, guys, this Monday, September 23rd, 8 p.m. Eastern Time, 5 p.m. Pacific. Limited spots. Do not miss your chance. Big announcement and a Q&A. You guys can chat with me. Links in the information box below. Guys want to sign up? You're going to have to do it now before we fill up. Very limited spots. We'll see you guys on the next video. Thanks so much for being here. Be safe and let's grow our wealth together.